It's the Blue Collar Breakdown! Welcome to the Blue Collar Breakdown! Starting right now!
And welcome to the Blue Collar Breakdown. This is Tom Eddlem here, your Blue Collar Economist. This is episode number 14, and we're going to talk about the Federal Reserve lowering interest rates 0.25% and what that means to you today. But let's begin by looking at what Jerome Powell said. And, that's not the one I want. Where's the word? Okay, here we go. Here's the beginning. Nope, that's also not the one I want. Here we go. Here's Colin Powell's press conference. And he says, good. I probably should have just gotten the clip, but I wanted to highlight a couple of points here. And you could see if you're watching rather than listening, you could see I've yellowed in, put a little yellow highlight on a couple of the comments. But he says, good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. That's what he begins with. What are the two goals? Maximum employment and stable prices. Those are the two goals of the Federal Reserve. That's what he says. And he repeats it 3 times in several hundred words in just a few minutes. So that's the message he's wanting to say. All right. And of course, if you read the second paragraph, he says, in support of these goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25%. We also decided to continue to reduce our securities holdings. Okay, so he's going to lower the Federal Reserve balance sheet, which they have been dumping a little bit. It's still way, way, way more than it was in 2028. But the main thing here is he's lowering it by 0.25 percentage point. Right now, the Federal Reserve effective federal funds rate is 4.33%. And most banks use that benchmark to make their mortgages and their the auto loans and all the rest of it. That's what it means to you. So, hey, for a guy like me, in the short term, I'm going to benefit because, hey, I just signed a mortgage for a house and the interest rate was nearly 7%. It means the interest rate's going to go down, and if you look a little bit further, they plan to continue to lower interest rates, and that means I'm going to be able to I'm going to be able to refinance next year, and probably at a lower rate. So let's see. Okay, we already have a comment here. Let's show it. All right, Chuck and Money says, I have heard a few people mention that we are in dragflation. Oh, come on. Why are you against the transvestites? Come on. No, we are. The one of the points that Chairman Powell made in his comments was that economic growth is going lower, unemployment's coming up, and inflation has continued to be at an elevated level. In other words, more than the 2% he wants. So absolutely, that's part of it. Okay, so he goes and he says, hey, we pulled all the guys in the Federal Open Market Committee, and here's the guys who decide the rates. So it's basically the chairman and all of the board of directors, or not all of them, but most of them, for the different Federal Reserve boards across the country. There's one in Boston, one in New York, one in Atlanta, San Francisco, et cetera, et cetera. And they've kind of voted, well, where are we going with this? Where are we going to go? And he said, the median participant projects that the appropriate level of federal funds rate will be 3.6% at the end of this year, meaning they're going to have another rate cut. 3.4% at the end of 2026, maybe another rate cut during the year then, and 3.1% at the end of 2027. So another one in 2027. And he basically says, we've changed our minds on this. We're going lower with interest rates than we had planned last year. He said, or even earlier this year, he says this path is, and I'm quoting here, this path is 0.25% point lower than the projected in June. And then he goes on to say, we don't really have a plan. Listen to this, okay? As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Policy is not on a preset course. In other words, we don't know what we're doing. We're just kind of eyeballing this. But the official narrative, and again, almost every single economic school, except yours truly, whether you are a Keynesian or an Austrian or a supply sider or a monetarist or oh man, what's the other one? What's the other really popular one that whatever, that almost every single school of economic thought says, look, if you want to stimulate the economy and you want to create jobs, you lower interest rates. All right. And the thinking behind it is this. And by the way, it's bad thinking. But the thinking behind it is this. Hey, if you lower interest rates, you create credit. What happens is the businesses invest and they create more jobs because they invest and create, they basically expand their businesses faster. But what happens is it creates malinvestment because this is not a market rate. It's the government interfering with natural intelligence, natural creativity. And you can't, it just doesn't work. And I have some statistics prepared for you tonight that show you just why it does not work. Okay, what I did was I took the annual GDP growth rates for the last 70 years, and then I took the Federal Reserve federal funds rate over the last 70 years, and I put them into little baskets, 5 little baskets. The ones with the highest Federal Reserve federal funds rates, the ones with the next highest, the ones with the next highest, and then like all the way over to the lowest. And here's what I came up with. All right. Now, I got another chart, but this one is not quite as clear. But if you look here, you can see on the left side, you've got 8.7%. That's the average federal funds rate for the highest 14 years. So most of these are 1980s, basically, right? These are the Volcker years when the United States is already in a huge recession. So if you look at the blue, the average economic growth for those years is 1.5% because there's this terrible recession. And we had, even before the Volcker years, or I should say the late 70s, we had terrible inflation and the real economic growth was not very high. So this is basically 77 to 85. There's a couple of years of solid growth in there, but there's a lot of recession. All right, and then there's a few other years. The next basket, you can see the economic growth goes up, and then it goes up again in the third basket, and then it goes down right to where it is in the Volcker years. So, when the federal funds rate is 3.3%, or as it's been in the last 25 years, 1.3%, with the exception of the last couple of years, you see very weak economic growth. You see 1.5 to 1.7%. All right. Let's take inflation out of this, because if you look at the Volcker years, a lot of these are actually not real positive interest rates. What I did was I took those numbers and then I said, okay, what is let me just, before I do that, let me go back to the interest rate thing. All right. It says here in Volcker's statement that right now the interest rate is 4.33%. All right. And the inflation rate is 2.9%. What does that mean? It means that the real federal funds rate after inflation is 1.43%. And what they're going to do is they're going to go down to 3.6%. And if inflation stays the same, the real rate is going to be 0.7%. And then at the end of 2026, 3.4% rate, well, that means it's going to be 0.5%. And then 3.1% in 2027, it's going to be 0.2%. Okay. That's going to be the real interest rate, because let's face it, if you borrow money and the inflation rate is very high, is higher than your interest rate, it's kind of like saying you don't have to pay your interest rate, your mortgage off. I have a friend who came here from Venezuela. I think I've told the story before. I'm going to tell it again. He bought a house in, I think it was about 2013. By 2017, he'd come to the United States, and he'd saved up his money before he left. He bought a house for 300,000 bolivars, which is it was like a 10-to-1 ratio. So it's like a house for $30,000, and he bought a 30-year mortgage, and his payment was, I don't know, $250, $300 a month. And he came to the United States, and a couple years later, his wife said, "You know what? Our mortgage payment just went under $1. What's going on?" And what happened is in Venezuela, inflation had gone up to several 100,000%. Later, it went up to 1,000,000%. And what that had done, because his mortgage was in bolivars and not in dollars, the amount of bolivars he owed when he was earning dollars in the United States was almost nothing. And he paid off his whole mortgage. It should have been $25,000 because it was only 5 years into his mortgage. So he still owed almost all the principal. He paid it off for $120 something because of inflation. If he'd waited another year, he would have had to pay $1. All right. So let's look at real interest rates, right? How much are you actually paying in interest versus how much is inflation taking off the interest rate? Okay. So that's what I'm saying here. And what I did was I took the real federal funds rate. So I took the federal funds rate, which right now is 4.33%, minus the 2.9%. So I came up with 1.43%. Okay. And I did that for all 70 years. And I did the same thing. I put them in baskets of 14 years, the highest real interest rates, then the next highest, and the next highest. And then at the very end, if you look on the right here, you can see the real interest rate was negative 1.3% average for those 14 years. Some of them were net minus 6%. Okay. But for the average of those 17 years, it was minus. And you can see here that the economic growth was very strong for those years when it was positive. And once it went down to once your interest rate, your average interest rate went down below 1.4, 1.2, your real interest rate went below a little over 1%, which is where we're at now, the economic growth just fell dramatically. Because if you can look here on the chart, when you've got 3.1%, you got real interest rates. We had 2.5%. Same thing, 2.5% or a little bit more when the interest rates were 1.4%. But once you get down to 1% interest rates, you're doing 1.5% growth pretty much throughout, 1.5. So you're losing about a full percentage point of economic growth every year by lowering interest rates. So the whole idea that this is a stimulative thing is disproven by the data. The economy grows slower when interest rates are lower. It's not a stimulant, it's a depressant. Okay? And let's go back to I keep wanting to call him Colin Powell, but let's all right, let's look at Jerome Powell's saying. This is a repeat of his introductory statement. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. Okay. How do you get maximum employment if you lower economic growth? How do you do that? My response is You don't. You get more unemployment. And this is on top of the idea that Trump is saying, oh, we have to add tariffs, and we're losing jobs because of tariffs. We're losing all of this other stuff. The Fed is making it worse, and Donald Trump, who's calling for Jerome Powell's head for not lowering interest rates fast enough, Donald Trump is cheering it on. This is where we're at. The level of economic ignorance is astounding, not just with the eggheads at the Federal Reserve, but with the president as well. And okay, so he said we are committed to supporting maximum employment and bringing inflation sustainably to our 2% goal. And of course, the Federal Reserve has said for a number of years, oh, what we want is inflation over the long term using our much more modest PCI measurement. It always is lower. It comes in lower than the CPI. What we want is 2% inflation over the long term every year. And that's a lot more palatable to workers than saying we want to cut your pay every year by 2% or more every year forever, because that's what it does. Okay. The idea that lowering interest rates or printing more money in this case as well, that lowering interest rates is going to create curb inflation is absolutely ridiculous. One of the things I like to point to is the house prices, because one of the things that lowering interest rates does is it raises commodity prices. And you may have noticed that over the last week or so, a lot of commodity prices have gone way up, whether it's Bitcoin or gold or silver or platinum, palladium, all of them are at like record levels. And it's because they all expected, and the stock market as well, all of them expected that the Federal Reserve would lower interest rates, and that helps, especially it creates a rush to assets because people realize, hey, wait a minute, there's going to be a lot more credit in the economy, so that means asset prices are going to go up, because if you have more credit, people can now afford to buy more assets. It doesn't necessarily mean that the consumer price index is going to go up more. It probably has some effect, but it's not the major effect. But what it does mean is that commodity prices are going to go up. Commodity prices like gold, like the stock market. And here's a little chart I put together a couple of years ago. The median house price to median income in the United States. And when I say inflation and lowering interest rates hurts the working person, I mean it very concretely. All right. This is, if you look at the median house price in the United States, and the median house price has not increased, median house size has not increased that much. I know there's a lot of propaganda out there about how, the average house has increased 25% over the last 50 years or 40 years or whatever the number is. But they use averages, not medians. All right. Medians are, or a lot of times they'll just use new houses, which doesn't count the existing stock. Okay. So the median house price is take all the houses out there and find the one that's right in the middle. Where there's half that are bigger and half that are smaller. That's the median. Okay. And then same thing with income, because average incomes are increasing a lot faster than median incomes because the rich are getting richer. Okay. So if you take median house price to median income, you look and you see this chart here from 1940 to 1971, the median house price to income ratio falls from, 3 times the average family's income down to about 1.7 times. And then since then, it's gone up to 4.6, 4.7 or whatever. It's gone up several multiples. And it got the slope on the chart. I have basically 3 colors on the chart for those of you listening, not watching. The gold standard plus normal interest rates. So we still have a gold standard under the Bretton Woods system. It's not a perfect gold standard, but it's a gold standard because gold is pegged at $35 an ounce up till 1971. And then you have normal interest rates, but you don't have a gold standard. You have inflation. You could see it starts to go up, but it really accelerates after the year 2000 with suppressed interest rates and inflation. So that's really what causes it. And what is the impact of that for you? Well, maybe it's not a direct impact to you if you're already in a house. If you're older and more mature and you already have a house, the inflation is helping you pay off your mortgage. And you don't have to worry about buying a new house unless you have to find a new job in a new city. Then you have to buy a new house and it has to be more expensive. But hey, you already got an expensive house to trade, so it's probably not that big a deal. But if you're a young person and the amount of money, the sticker price of a house has gone up to 4 or 5 times your average income, well, that takes a lot of time to save for a down payment. If you want to get 20% down payment, well, that's a full year's salary. So you have to save, if you make $65,000 or $70,000 a year as a family, that's how much you have to save just to, not pay PMI. I mean, there are programs out there to have a lower down payment, but it's still more than twice as hard as it used to be before that. Not more than twice, about twice as hard as it used to be before they started just suppressing interest rates. And what they're doing, the reason the interest rates are going down is because the billionaires demand it. The billionaires want this. The average person doesn't want this because it costs them more money. So, all right, here we go. Chucking money's back. He's chucking money somewhere, trapped in his house. Yes, I can't afford the house I have if I move, even if I sell the one I have. I know a lot of people in that situation. And that's why excuse me. Actually, let me put Chuck and Money's comments up here. A lot of people are in this position, and the reason why they're in this position is this. And this is, when you bought your house, interest rates were suppressed, but prices were high. And then what happened was they raised the interest rates. But the problem is what it did was it put a lot of people trapped in their houses, and it made it so that the average person couldn't afford the monthly payments. All right. So, or couldn't afford the monthly payments if they had to refinance. So they're stuck with this really great interest rate, a huge mortgage that has doubled or tripled the actual value of the house if it were done under regular market conditions. So you can't afford to move. And what that created for a period of time, you would think, and according to market conditions, if you raise the interest rate, well, the monthly payment goes up, then that means the sticker price has to come down. And that is what the pressure that was happening. However, because of people like Chuck and a lot of people I know, they couldn't afford to move, so they couldn't sell their house. So there's no stock on the market. So there's no reason why they would do it. Now, if the prices came down, then they had to wait basically for the prices to come down, and prices didn't come down. And this is what the billionaires do not want, because they cannot afford to have their property values lowered. And there's a similar effect with stocks and with other commodities too, but it's particularly prevalent in real estate because most of the time real estate is leveraged 4 to 1. You put down 20%, you borrow 80%. So out of 5 shares, you 4 of them are debt and 1 of them is equity. Stocks typically aren't leveraged that much unless you're into derivatives and that type of thing. But this is what lower interest rates from 2000 to 2022 did to prices in the housing market. Now, had Jerome Powell had the courage and he had the support to keep interest rates higher, what would have happened is the prices would have gone down, and the it would have been more affordable for for people to move. Now, it may mean you're underwater a little bit in your mortgage, or a little bit less underwater, or you have a little bit less equity than you otherwise would have, because you still have underlying inflation. But it would mean you'd be able to move, and there would be supply in the housing market. But it took a while for that to happen. And I think if you look at the housing supply, the housing stock in the market, it went from almost zero in 2023 and 2024 to, all of a sudden there's all these people that they just have to move. They lost their job. They're moving to another city. They got a different job, or there's people that, hey, I don't care. I just have to get a house right now. I've saved up some money. I'll just roll the dice. That's basically where I was in. So the situation I was in. So there's all these people in the housing market buying houses and selling houses where there weren't before. So the prices were about to fall, and that's why Jerome Powell stepped in. I keep wanting to say Colin Powell. That's why Jerome Powell and the Fed stepped in to kind of buttress those property prices and keep really young people out of the housing market. Because if you look at the housing ownership rates for young people 25 to 35, they are plummeting. In the 1980s, more than half the people 25 to 35 owned a house. Right now, it's about 37%. So they can't afford to buy a house. And it's not that they're buying. It's not that they are just spending too much on avocado toast and $6 coffees. It's because the market is being manipulated against them. And that, and you can see that in the record prices of all the other commodities. So one of the things that came up this week is the price of gold went way up. I don't have a lot of coins. I sold a bunch to support Ron Paul, but I did recently. By recently, I mean like a couple of years ago. I bought a $1 gold coin. Let me just see if we can show you this. I don't know if it'll show. It's a $1 gold coin. It's 18. Yeah, it's a little Indian princess head. It's a $1 gold coin. It's smaller than a dime, and the value of that, the melt value of it. Now it's kind of a nice piece. I paid $300 for it a couple of years ago. When I bought it, the melt value was $97, and the melt value right now, as you can see, I just went on a website, $177 and change, because the value of gold is $3,700 an ounce, and this is only a tiny percentage of an ounce. But a dollar used to be a dollar. Wages used to be paid in gold and silver. Just to give you an idea, here's the inflation calculator. January 1913, the Federal Reserve was created in January 1914, but if you had a dollar in 1913, you need to have $33.06 right now in order to buy the same amount of materials. However, if you have gold, if you have a gold coin like this, well, you get 4 times as much, 5 times as much, right? 33 times 5 is more than 5 times as much. All right, because gold has held its value better as products have gotten cheaper through automation and more efficiency and all the rest of it. Okay, silver, not so much. Again, just a reminder. Okay, the average dollar is only one. It's 1 to 33, but if you go to a silver, I have a Morgan dollar, silver dollar, and if you look at the melt value, it's almost the same, right? $32.41. I think yesterday it was about $33, and the silver went down today. All the commodities did the opposite of what they should have done. They should have gone up, but I think a lot of it had been priced into the market. Everybody was expecting the Fed to do the 0.25% rate cut. I think it would have gone up if it had been a 0.5%. But anyway, yesterday it was about $33, so it was almost exactly the same as inflation. And that's one of the things about silver. It's a much more common element. It's much easier to mine. There's a lot more of it, so it's going to keep up with prices. Whereas gold, even though it's increasing in quantity, it's increasing in quantity in circulation much slower than the silver that's available. Gold is a much more rare earth element. It typically it's a 1% to 2% per year that's increased, although I think it's about 4% last year. But the point of it is, over the long term, the amount of gold that has increased in circulation has been a lot slower than the amount of production of wealth. And as a result, gold has appreciated about 0.5% to 1% every year over the last 100 years. And as a result, you have this being worth 5 times as much as a dollar that you got in 1913. 1913, these are equal. All right. Today, you need 177 of these to equal one of these. And if I had a silver dollar in my hand, you need 33 of these, or 32 or 33 of these dollars to equal a silver dollar. So silver is, I would argue, slightly inflationary. Actually, arguably, gold is inflationary because it increases in circulation. There's let me go to another check. I'm going to keep doing the check. All right. I heard they're making stable coins tied to gold and silver. I wonder how those will do. Yeah, I wonder too. Gold and silver are commodities, despite what George Gilder said. I actually read his book, something, I forget the title of it. It's something like Life After Capitalism. And he argues that gold is not a commodity, it's money. But it is a commodity. It is bought and sold, and just as silver is. And they both fluctuate up and down over the years, just as others do, but within a tighter range than, say, Bitcoin. And my argument is, if they make a stable coin, that would be great. I've hypothesized that we could do a quad metalism, where you would have a basket of metals, maybe gold, silver, palladium, and platinum. And, for $5,000, you'd have an ounce of gold, ounce of silver, ounce of palladium, and a pound of silver, or something like that. And therefore, you wouldn't differentiate. So the various metals could fluctuate up and down in the basket, and then you'd have a fairly stable currency. But right now, what we have is, the federal government prints what it wants when it chooses to, and what's holding up the value of the dollar is the fact that I need them every April 15th, or I go to jail. I'd have to pay them to the federal government. I'm required to account my profits and my wages in Federal Reserve notes. That is one of the key things. One of the things that workers should be asking is, hey, why did we used to get paid in gold and silver? Gold like this. We used to get paid in this. Now we get paid in this. Who stole the value of this? Who stole the value in this dollar, which used to be the same as gold? Well, here's a handy little cheat sheet for you. The counterfeiters always leave their name on the counterfeit. The thieves who stole the value always leave it on. If you look at a dollar, it always says Federal Reserve note. All right. Who stole the money? Federal Reserve. That's who stole it. You want to know why their workers aren't paid in gold and silver anymore? Because the Federal Reserve stole it and gave it to the billionaires. It's really that simple. Over time, the dollar has lost 99.5% almost 99.4% of its value when it was compared to when it was gold at $20.67 an ounce. Now it's roughly $3,700 an ounce. So it's lost 99.4%. It's lost 97% of its value when it compared to silver. The silver dollars that used to circulate. And who stole the value? Well, the Federal Reserve Bank. It's their policy to keep stealing the value. If you go to their website, if you go to their statement today, all right, what do they want? They want, we remain committed to bringing inflation sustainably to our 2% goal. We remain committed to stealing 2% of workers' wages every year forever. That's how you should read it, because that's what it does. All right. The billionaires who work with debt, they do not care about inflation. They love it. All right. Just like my Venezuelan friend who bought the house in Venezuela in bolivars and basically got the house for free. All right. The billionaires love inflation. Working people, it comes right out of their wages. And you know that intuitively because you go, the CPI increases, you go to the store. Oh, look, I'm paying more for coffee. I'm paying more for this. I'm paying more for that. Well, that's inflation. Well, it's tariffs lately, but it's inflation most of the time. And that comes out of your paycheck, and it doesn't disappear to nowhere. It disappears into someone else's hands. Yes, the government, they print them and then they use them, but it also goes to billionaires who work with debt, people in the finance industry. And until there's a revolution, a financial revolution, it's going to continue. All right. So that's my podcast for today. I think I covered everything I want to cover. And I have one more chart to show you. I've done it before. I've shown you this before, I think, but I just to drive the point home. This was a chart that was on one of my Libertarian Institute articles about a month ago. I looked at average GDP growth rate by period. And if you look on the left, it's where we have a gold standard. It's before the Federal Reserve. So there's no central bank, and there's market interest rates. And you see the average real GDP growth rate is 4%. All right. Then you go forward to a real gold standard. Most of the time, 1913 to 71. Admittedly, there's two parts to that, and up to 35, and up before 35 when gold is $20.67 an ounce, and afterwards 35. But you can see GDP growth rate was cut by 0.5%, 3.5%, still way better than we're doing right now. And then 71 to 2000, we got 3%, 3.3%, a little over 3.25%, 3.3%. That's still pretty good. And then since then, only 2% real growth. And why is that? It's because we have a Federal Reserve Bank. We have no gold standard, and we have low interest rate. We have below market interest rates, and there's all this malinvestment. And what happens is everything crashes. We have low interest rates, and there's a housing market boom. And what happens? There's also a housing market crash. And the same thing is happening in all the industries when the interest rates are below average, below the market rate. And it's continually happening. And that's why the real GDP growth rate is so low under the current era. All right. I think that's it. At a piece published by the Libertarian Institute about Charlie Kirk cancel culture on Tuesday. So you want to go to the Libertarian Institute and read that one and read all the other great stuff that they've got there. There's tons of great stuff at the Libertarian Institute. libertarianinstitute.org. Also, I have another piece coming up next week. I don't know when it'll be published, but it's on immigration and crime rates. So, like, subscribe, comment, whatever you do on Rumble, do that too. Because we're on Rumble, we're on YouTube, we're on Facebook. All right, I'll see you next week. Always back to working man.
the face.